Imagine you spent the last 3 years saving. Every vacation you skipped, every dinner out you passed on, every impulse purchase you talked yourself out of. You've got $80,000 sitting in a high-yield savings account. Your credit score is 760, and you finally feel ready. You call up a realtor, you start touring homes on weekends, and then you sit down with a mortgage calculator and realize your $80,000 down payment on a $450,000 house is going to cost you $3,400 a month before taxes, before insurance, before a single thing breaks. And the house isn't even that nice. That moment of dread right there, that's exactly what millions of Americans are feeling in 2026. And if that's you, I need you to stay with me for the next 12 minutes, because what I'm about to walk you through might be the most important financial decision you make this decade. My name is Smith, and I spend way too much time thinking about real estate, interest rates, and the psychology of why people make catastrophically bad money decisions at exactly the wrong time. If you're someone who's been on the fence about buying a home, wondering if now is finally the time, or feeling pressure from your family, your friends, or just society in general to stop throwing money away on rent, hit subscribe and give this video a thumbs up, because this one's for you. Here's the thing. I'm not here to tell you that you should never buy a house. Home ownership is a legitimate wealth-building strategy. I own property, I understand the appeal, but what I am telling you is that right now, in the current market, buying a home could be one of the most financially destructive things you do to your net worth. And the scary part, almost nobody is talking about this clearly. So let's talk about it clearly. First, let's set the stage, because context matters enormously here. The American housing market has been in a slow-motion pressure cooker since 2020. When the pandemic hit, interest rates dropped to historic lows. We're talking 2.65% on a 30-year fixed mortgage in January of 2021. That's practically free money. And predictably, demand exploded. People bought homes like they were buying lottery tickets. Prices surged 40, 50, even 60% in some markets over just 2 years. Then the Federal Reserve, trying to fight inflation that it helped create, raised interest rates at the fastest pace in 40 years. By late 2023, mortgage rates were north of 8%. Now in 2026, they've settled around 7 to 7.5%, and everybody keeps saying, oh, rates will come down, just wait. But here's what most people don't realize. Even if rates drop to 6%, the damage has already been done. The prices never came down to match. And that combination, high prices plus elevated rates, has created a market that is fundamentally broken for the average buyer. Let me show you exactly what I mean with the math, because this is where it gets interesting. In 2019, the median home price in the United States was $258,000. At a 3.7% mortgage with 20% down, your monthly payment was about $954, just under $1,000 a month, totally manageable for a middle-class family. That same house today, adjusted for what's happened to prices, is now sitting at roughly $425,000 in many markets. At a 7.25 rate with 20% down, that monthly payment is $2,320. Same house, more than double the payment. That's an extra $16,000 a year coming straight out of your pocket. Now, you might be thinking, okay, Smith, but I have to live somewhere. Rent isn't free either. And you're right, but here's where the psychological trap kicks in that almost everyone falls for. The price-to-rent ratio isn't as simple as people make it sound. There's a concept called the price-to-rent ratio. It's one of the most useful tools in real estate analysis, and almost no one in a casual conversation about buying a home ever mentions it. The way it works is simple. You divide the purchase price of a home by the annual rent you'd pay for a comparable property. Historically, a ratio below 15 means buying is clearly advantageous. A ratio above 20 means renting is likely the smarter financial move. Right now, in cities like Austin, Phoenix, Nashville, and Miami, cities that people were flocking to just 3 years ago, price-to-rent ratios are sitting between 24 and 32. That is objectively, mathematically, in the renting wins territory. Think of it this way. If you can rent a house for $2,000 a month that would cost you $3,400 a month to own, you're essentially paying $1,400 a month for the privilege of being a homeowner. That's $16,800 a year. Over 5 years, that's $84,000. And that money isn't building equity. That's the delta, the difference between what owning costs and what renting costs. You could take that $84,000 and invest it in index funds, and historically, the stock market has returned about 10% annually. Run that out, and you're looking at a meaningfully different financial picture than the one that just buy a house crowd is painting for you. Here's the thing, though. This isn't just about math. This is about psychology, and the psychology of home buying is one of the most powerful forces I've ever studied. There's a phenomenon called the sunk cost fallacy. Once people have been searching for a home for 3 or 4 months, gone through the emotional roller coaster of making offers, getting rejected, touring house after house, they become so emotionally invested in the outcome that they lose the ability to make a rational decision. They need to win, they need to buy, and that emotional desperation makes them vulnerable to overpaying by $30,000, $50,000, or more just to end the pain of the search. Real estate agents know this. There's a reason they encourage you to visualize yourself living in a home, to imagine your furniture in the living room, to picture your kids in the backyard. They're not doing that to be friendly. They're collapsing the psychological distance between you and ownership so that your emotional brain overrides your analytical brain the moment you sit down to make an offer. And then there's what I call the adulting pressure. In America, we've built a cultural story that equates home ownership with success, stability, and adulthood. Your parents ask when you're going to buy. Your friends are posting photos of their new kitchens on Instagram. Your coworker who bought 3 years ago keeps talking about how much equity he's built. And so you start feeling like you're behind, like you're losing, like you're failing at life. That pressure alone drives more poor financial decisions than almost anything else in personal finance. The desire to appear financially successful pushes people into the single biggest purchase of their lives at exactly the wrong moment in the market cycle, and nobody's telling them to stop. Now, look, I hear the argument, and it's worth taking seriously. Smith, you build equity in a home. Renting is throwing money away. I need to address this directly because this is one of the most misunderstood concepts in all of personal finance. Yes, you build equity in a home, but in the early years of a mortgage, you build very little of it. On a $425,000 home at 7.25%, in your first monthly payment of $2,320, roughly $1,845 of that goes to interest. Only $475 actually reduces your loan balance. That means in your first year, out of nearly $28,000 in mortgage payments, less than $6,000 actually goes to equity. The rest goes to your lender. Is that so different from throwing money away? And that's before you factor in property taxes, which in most states run between 1 and 2.5% of the home's value annually. On a $425,000 home, that's $4,250 to $10,600 just in taxes. Add homeowners insurance at around $2,000 to $3,000 annually, routine maintenance, which financial planners suggest budgeting at 1 to 2% of the home's value per year, and suddenly the actual cost of homeownership is dramatically higher than the mortgage payment alone. We're talking about an all-in annual cost that could easily hit $45,000 to $50,000 every year.
This is where it gets interesting, because people who bought at the peak in 2022 are starting to experience something that the market hasn't seen since 2008. It's called being underwater, meaning the value of their home has dropped below what they owe on the mortgage. According to ATTOM Data Solutions, the share of seriously underwater mortgages began rising again in late 2025 for the first time in years. Certain markets in the Sun Belt, particularly in Florida, Arizona, and parts of Texas, have seen 8 to 15% price corrections from their 2022 peaks. That might not sound catastrophic, but on a $450,000 home, a 12% correction means you've lost $54,000 in paper wealth. And if you put 10% down, you're now completely upside down. Here's what most people don't realize about the 2026 housing market specifically. We are in the early stages of what economists are calling a demand drought. The combination of high prices, Elevated rates and a generation of buyers who simply can't afford to enter the market has caused transaction volume to fall off a cliff. Existing home sales in 2025 hit their lowest level since 1995, according to the National Association of Realtors. Think about that. We haven't seen this few homes change hands in 30 years. And low transaction volume historically precedes price corrections because sellers who need to sell are forced to start cutting prices to find the buyers who are left. There's also a shadow inventory problem developing. Millions of homeowners who bought or refinanced between 2020 and 2022 are locked in at 2.5 to 3.5% mortgage rates. They're not moving voluntarily. Why would they trade an $1,100 monthly payment for a $2,300 one? This is what analysts call the lock-in effect. It's been suppressing supply for 2 years, but life doesn't stop. Divorces happen, job relocations happen, estate sales happen. As more and more of these forced sales accumulate, that locked-in supply begins to leak into the market, whether those owners want it to or not. Add to this the wave of adjustable rate mortgages that were originated in 2022 and 2023 that are beginning to reset. Homeowners who took 5/1 ARMs thinking rates would drop by now are instead seeing their payments jump by $600 to $900 a month. Some can handle it, many can't. That's more inventory coming to a market that already can't support current price levels. Now, you might be thinking, fine, but won't the Fed cut rates and save everything? This is the hope that the entire real estate industry is banking on. And here's the cold truth. Even a significant rate cut doesn't fix the problem quickly. There's a concept called the mortgage rate lock paradox. When rates fall, yes, buyers gain purchasing power, but falling rates also unlock that shadow inventory we just talked about. Sellers who've been waiting suddenly list their homes. Supply floods back in. It's not a clean recovery, it's messy, and the historical data suggests that meaningful price corrections tend to happen in the window between when demand dries up and when that pent-up supply fully enters the market. That window might be right now. Here's the thing. I'm not predicting a 2008-style crash. I want to be clear about that. The mortgage underwriting of 2020 to 2023 was dramatically more conservative than the subprime era. Most homeowners who are currently locked in have strong credit, fixed rates, and genuine equity. This isn't a systemic banking crisis. What I am saying is that we are highly likely to see a 10 to 20% correction in overheated markets over the next 18 to 36 months. And if you buy today, you may be buying at the absolute top of that range with a payment that could be $400 to $600 lower per month if you simply wait. So what should you actually do? Because I'm not here to leave you feeling paralyzed. I'm here to give you a framework. First, if you're currently renting and feeling the social pressure to buy, give yourself permission to wait strategically. Waiting is not losing. Waiting while your down payment earns 5% in a high-yield savings account, while you watch the market, while you track price reductions in your target neighborhood, that is a financial strategy, a good one. Second, calculate your local price-to-rent ratio before you make any decisions. Go to Zillow, find a home you'd want to buy, find a comparable rental, do the math. If that number is above 20, renting is likely the financial superior choice in your market right now. This is data-driven clarity, not emotion. Third, if you absolutely must buy because your family situation demands it, because you found something truly exceptional, because your circumstances are unique, at minimum, make sure you can genuinely afford the payment at 28% or less of your gross income, that you have 20% down to avoid PMI, and that you have 6 months of expenses still sitting in savings after closing. Anyone who tells you to drain your emergency fund to buy a house does not have your financial interests at heart. Fourth, track the distressed sale data in your market. Watch foreclosure filings, watch days on market, watch the percentage of listings with price reductions. These are the early warning signs of a softening market, and they will tell you when the window to buy is actually opening rather than closing. And fifth, and this is the one that matters most, separate the financial decision from the emotional decision. A home is not just an investment. It is a place to live, to raise a family, to build a life. There is real value in stability that spreadsheets don't fully capture. But that value is not infinite, and it certainly doesn't justify buying at a price point that strains your finances, compromises your emergency fund, and leaves you one job loss away from disaster. Here's what I keep coming back to. The wealthiest people I've studied in personal finance didn't get rich by following the crowd at the moment of peak enthusiasm. They got rich by being patient, by being contrarian when the data supported it, and by having the emotional discipline to say not yet when everyone around them was saying right now. The housing market in 2026 is telling a very specific story if you're willing to listen to the data instead of the noise. Prices are elevated, rates are elevated, transaction volume is near historic lows, shadow inventory is building, affordability is at its worst point in 40 years. These are not the conditions under which you want to make the largest purchase of your life. Wait, save, stay sharp, and when the market gives you a real opening, not a social pressure deadline, not a fear of missing out, not a realtor telling you this is the last one at this price, when the actual math works in your favor, that is when you move, not before. The people who are going to build real wealth in real estate over the next decade aren't the ones buying right now out of fear. They're the ones sitting on cash, watching the data, and getting ready to buy when everyone else is too scared to. That could be you. It should be you. And if this helped you see your situation a little differently, or if it gave you the permission to step back and think instead of just react, then this video did exactly what it was supposed to. Hit subscribe if you want more content like this. Drop a comment below and tell me what market you're in and what you're seeing. I read every single one. And if you've got a friend who's about to rush into a home purchase they can't really afford, do them a favor and send them this video. It might just save them $100,000. I'll see you in the next one.